With Trump's pivot of no pain, no gain, the market has been extremely choppy over the last few weeks. And maybe Jerome Powell just saved the market. In this video, we're going to recap the last week. I'm going to talk through some strategies towards the end of this video that I think are going to actually outperform the market. Now, if you're new to the channel, welcome in. I take a very contrarian approach to investing. And as we can see here, I'm actually dominating most indices. Right now, my account is up about 4.18% year to date, while benchmark is down nearly 6%. Russell's down almost 7%. S&P is down 1.66%. And the Dow Jones is up about 1%. So overall, we're handling the market pretty well, and we're overweight cash while we're still outperforming. And this is something that I brought to your attention early on. So towards the end of this video, I'm going to talk through why I'm going to rebalance a certain way going forward, because I do think volatility is going to be here, and I think you need to protect yourself from downside risk. Now, with Donald Trump's new policies, he did state there is going to be some disturbance here, but everything will be okay. And to me, guys, if you've been following the channel, I said regardless of whoever's in office, if the government spending slows down, we're going to be seeing a recession towards the end of this year. And I still think we're on pace for that. And actually, I think it could happen even sooner. There might even be a case that we could be entering a recession as we get into April-May timeframe, which is about 4 to 5 months sooner than I even anticipated.
And survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain stable and consistent with our 2% inflation goal. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
So while the S&P 500 was tanking during the day, was actually down as low over 1.5% on the day. When Jerome Powell spoke, we saw a nice spike back up here. Now, I think this is multiple reasons. I think number one, it was nice to see a voice of reason. Now, Powell did state he's going to keep rates pretty much where they are until the economic data makes sense. But if that is true, I tend to think that we are going to be into some serious turmoil without any accommodation from the Fed, which is going to possibly make this recession happen a little bit sooner. And we're already starting to get signals of this happening. I brought it up in my last video, and it is happening, ladies and gentlemen. We watch unemployment go from 4 to 4.1%, which is not a big move, but the forward-looking data is actually starting to get scary here. We're watching private payrolls really slow down here because of the uncertainty. So a lack of hiring. We're also watching a tremendous amount of cuts from big tech and also the Doge. Doge is making a tremendous amount of government cuts with veteran cuts as well. We can see that the foreshadowing of private employment is coming down. We have cuts in government spending, and this has yet to be baked into our overall unemployment. And so I do think we're going to see unemployment slowly trickle up here. So while we are sitting at some extreme fear here and had a nice rally at end of day as Jerome Powell took the stand, there is some concerns here that I have with credit spreads. If you're not familiar with credit spreads, it's basically the separation between high quality debt versus low quality debt. And there is not a lot of separation, which means there's not a lot of pricing for defaults. And this is where I see a massive problem here. Most of the time, something destructive has to happen in order to have a recession. Number one, I think there's been an overhiring in labor markets. Number two, I think there's been extreme liquidity and greed in this market, creating financial bubbles and coming in the form of credit and stock market. I believe these bubbles can burst in a manner that nobody sees coming. If credit spreads blow out, I think a lot of these asset bubbles in the market are going to tank by 40 and 50%. I'm not talking about your highest quality names. Yes, they're going to fall as well, and they're probably going to fall pretty hard. I'm talking about the names that have rallied multiple hundreds of percents and trading off of sales and not actual fundamentals. When you're talking about companies trading for 15, 20 times sales, and yet the free cash flow is non-existent, this is a massive bubble in my personal opinion. That'll eventually get popped when liquidity dries up. Credit is a massive market. The debt market is a massive market. much larger than the stock market. So if this blows out, you can bet that we're going to see some serious problems in the stock market. And if we just go through history here, anytime we have credit blowouts, you can see that it has triggered recessions. Now, of course, there's been multiple times that we've been able to kind of handle some of these blowouts, but a lot of the times they do lead to some serious financial dysfunction. And we can see credit spreads are historically low here. And there's only one direction, in my opinion, for them to go. And in my opinion, I think credit spreads are going to blow out here pretty soon because there's just not enough pricing for risk in this market when you have political tension, tariff uncertainty, multiple wars going on. And while this has been going on for a while, while we've seen credit spreads going down for a while, the one thing that's been backing this up has been monetary policy and government spending, both of which have shifted on a dime here. We now have a government that's making cuts and is trying to spend less. We now have a Federal Reserve that is holding steadfast. So we're not easing into what I think could be some pressure here. So if we take the market year to date, we can see that the market is down roughly 1.68%. So it hasn't really moved a lot, but what I want to show you is after the recent high here, we've actually fallen pretty substantially, down over 6%. Now, of course, this is not going to be financial advice. This is just personally where I'm thinking about allocating going forward. Every quarter, I'm rebalancing my portfolio. I think you really need to be actively managing here. Now, if you don't have the time to do so, just dollar cost averaging into an index, set and forget it. But I definitely would be overweight still bonds in this market here. I would have probably somewhere between 15 to over 20% allocation in some sort of short-term treasuries, getting 4 to 5% and having the ability to take advantage of market dysfunctions. As we saw, credit spreads are extremely tight. If those blow out, I think you're going to have tremendous buying opportunities. If labor markets soften more, you're going to have buying opportunities as well. So I tend to think that there's going to be more buying opportunities. But what I do want to let you all know is that we are just bouncing off the 200-day moving average, which is just a healthy rebound here. We literally smack dab on the 200-day moving average. Jerome Powell spoke and we bounce right off of that. You can't even make this stuff up. But it's been pretty clear that this market has had a hard time breaking and staying above 6,000 and making new highs. So if I literally draw a line at 6,000, you guys can see here visually how hard it's been for this market to really go above 6,000. And after the recent sell-off, we've come and put in a lower low, which could be a problem here. So if we take it down from here, we have a lower low, a lower low, a lower low, a lower low. And this is a signal that we could be getting lower lows and that the market sentiment could actually be shifting if we do not get some sort of reversal here off of the 200-day moving average. And guys, I don't want to get in the nitty-gritty of the technicals, but just wanted to point this out. So where could you hide? How can you possibly outperform this market? Now, if you think the market's going to rip up, then obviously ignore everything I'm saying. But if you think it's going to be choppy, then I definitely think you want to be looking at these covered call ETFs with overweight bonds and slowly picking off quality names that sell off. So if we compare the S&P 500 to SPYI, which is the S&P 500 with a covered call strategy here, this is where it becomes interesting because we can see that it basically trades in lockstep unison, meaning you're getting the upside and downside of the S&P 500. But what are you getting here is you're getting over a 12% yield annually. Now, the more volatile the market is, technically, the higher these yields should be because the covered call strategy should allow for higher premiums as the market gets more volatile. Well, yes, over the last 6 months, it's basically trading step for step with the S&P 500. Yes, slightly down, but if you were able to enter in these points, you're basically trading mirror to the S&P 500, maybe slightly different on big upturns and big downturns. It's probably not going to have as much downside risk, probably not going to have as much upside opportunity, but what you are getting is every month you're basically getting a 1% yield on those covered call strategies. So over the last 6 months, yes, SPYI is only up about 1%, while the S&P 500 is up 6.7%. But what you're not seeing here is that the SPYI pays a monthly dividend of over 1% on high volatile months. So you have to add nearly 6 to 7% to the total returns here, which puts it in lockstep basically with the S&P 500. Now, not as much downside risk is what the insurance is, and the fact that you get a dividend payout dividend allows you to reallocate those funds to where you're seeing dips in the market while not exiting the market. So this is where I think the strategy could make sense. Normally, I don't like covered call strategies, but I think when it's volatile and choppy and the markets are going to stay flat to down, you definitely want some exposure on those rip up days, but you don't need a lot of exposure because if I put, let's say, 25% of my account in covered call ETFs, 25% of my account in maybe some sort of bonds, I'm going to have very, very low beta with some upside. So if the market's really choppy, my account's going to stay flat, but I'm going to have high yield in that account. And then with the other 50%, I can start allocating to high quality names that are dipping that I may want to own long term. Now, the other thing we're seeing in this market is we're seeing a big move into Chinese stocks. So year to date, we're looking at S&P 500 that's basically down at 1.68%, and the K-Web is up 28.8% on the year to date. We're seeing US stocks really underperform globally, but specifically China big time. I tend to think that this is more of a trade than a longer term trend. I think there's going to be more headlines coming. I think it's going to be volatile for most sectors. So as always, ladies and gentlemen, this is just my opinion. I think that the move in Chinese stocks have been extraordinary. Maybe they are going to break out to newer highs here, but I definitely think you could be playing the volatility with a lot of the covered call ETFs. Another one that we can actually think about here is going to be JEPI, which I brought up before. And actually JEPI year to date is outperforming the S&P 500 up 1.23%. And this is not including the dividends that JEPI pays on a monthly basis, which I believe annually it pays anywhere between 7 and 9%, depending on the covered calls that they're getting. So I believe that this is a strategy that could work into a very, very choppy year, being overweight cash, looking at a covered call ETF that's professionally managed that you can kind of set and forget, and then slowly picking up high quality names. And I would also be looking at international exposure as well, something like VT. If we get a substantial market sell-off, you definitely want exposure to those emerging markets. You know, a market that I'm personally looking at is India. I think if India keeps selling off, that is going to be a market that I definitely want exposure to. We look at year to date, it's definitely been an underperformer. But if we take it over the last 5 years, India is definitely progressing as a country. And the chart is showing that population is growing, technology is growing. And this is definitely an area where I would want some exposure on a big enough pullback. So for me, you know, this is kind of where my mind is going. I want to share that with everybody. Hopefully everybody enjoyed. I definitely think, you know, REITs have worked well. I definitely think REITs have worked well, but I also would say that I would not be shocked if we see some craziness with Treasury. Once again, that could put pressure back on REITs. So while it's worked out over the last 6-7 months, we've taken our gains from things like Vici properties, and now we're looking to reallocate as we head into another quarter here. And as I showed you guys, this is where my mindset is going, just waiting for the opportunity to present itself. As always, want to be transparent, share with you what I'm doing, and we will see you all in the next one.